Hey guys, welcome to my channel Accounts Accuracy. In my previous video, I have already explained that what ratio analysis is. I hope you might have seen my first part of this ratio analysis videos. This is the second part in which we are going to study about the classification of accounting ratios. Now, there are four types of accounting ratio. The first one is liquidity ratio, solvency ratio, activity ratio and profitability ratio. Now you must think as a businessman. If you are a businessman, you will definitely want to know that how efficient your company is in paying off all your short-term loans. So that is why any company calculates the liquidity ratio to know its efficiency in paying off all its short-term loans. Next to that comes solvency ratio. Here what happens after paying all the short-term loans, company also wants to check that how company is well efficient in paying off all its long-term loans. Next comes your activity ratio. Now this tells us that what company's situation is, whether company is going higher and higher or is it going lower in terms of transaction, that what is the activity position of the company, whether in terms of transaction it is going higher or not. Last is your profitability ratio, and you know that profit is the blood of business. That is why profitability ratio is calculated in order to know about the profit position of the company. Let us study next, that is liquidity ratio. Liquidity ratio means the ability of an enterprise to meet its short-term financial obligations as they become due for payment. And you know that any company's reputation depends upon its readiness to pay any loans. Now, if the company will be well prepared by knowing about its position of paying off loans, it would be great. Now, you must know that a low current ratio means that the enterprise may not be able to meet its current liabilities, and on the other hand, high current ratio means the funds are not used properly and lying idle. The ratio must be 2:1. This is the formula for current ratio, that is current asset by current liabilities. These are the current assets, that means cash in hand, cash at bank. Again, the inventories, bills receivable plus debtors, which together makes the trade receivables of the company. Then comes loose tools. Now all this starts means when you purchase the raw materials, you start with cash and you know that goes converted into finished product, and then again your cash comes back in your hand. This is the regular process of the business. So all the assets which could be converted into cash within a year forms the current asset of the company. In current assets, we also include loose tools. But these loose tools doesn't make the part of current assets in calculation of current ratio. Why? Because loose tools are used by the company. These are not kept for sale purpose. So that is why for calculating the current ratio, include loose tools. Now you should know that what current liabilities are. Current liabilities are your short-term borrowings, trade payables, other current liabilities and short-term provisions. These are those liabilities which are paid within a year. Now suppose the company has debtors of 30,000 and creditors of 10,000. Debtors are the person who owes money to the company, and creditors are the person whom company owes money. Or you can say the current assets must be more than the current liabilities, because that only tells us that the company is in position to pay back its creditors. If some of the debtors may fail to pay the money, but still company will be having enough money to pay back its creditors. Difference between your current assets and current liabilities gives you working capital. That means this is the only money which company has invested of its own. Otherwise, current liability is the outside liability which company invest in the business of outsiders. But when you find out the difference, you notice that the rest of the amount is the actual money which company invests of its own. So working capital is what? Basically working capital is the real money which belongs to company. So why I am explaining it, that would be well understood by you when we will be doing the question. If you'll be keeping your stock idle in the, now you should know that if any businessman would invest money in the current asset by purchasing, suppose, the raw material and kept in the godowns for longer period of time, that would be kept idle in the godowns. But if instead of that he would have invested in the in savings account, then he could have earned more money as interest. So that is why any businessman never think of do this mistake. Now you see, in this sum you are provided with trade receivables, working capital, current liabilities, and you know that you are not provided with the exact current asset value. And in the previous slide, I have already shown you how to calculate working capital, the amount which is actually invested by the businessman from his own pocket. So what you will do here, you will simply find out the current assets by applying that formula. What you will do for finding out current assets, you will simply add the working capital in the current liability. And here you will get the value 6 lakh is your current asset. Once you get the current asset, that would be divided with current liability, and your current ratio will come, that is 2.5:1. Now you must be thinking that what to do with the trade payables. Then you must know that trade payables are already included in current liability. Therefore, that will not be taken in calculation of current liabilities. Next comes your liquid assets. Now what is liquid asset? It from all current assets. When we remove prepaid expenses and inventories, it becomes liquid assets. That means liquid asset is basically the part of current asset. All the liquid assets could be your current assets, but all the current assets can't be liquid asset. Why? Because these two, prepaid expenses and inventories, cannot be converted into cash quickly. Now here is the sum which is provided with current liabilities, current assets, inventories, prepaid expenses and trade receivables. Now first of all, you can see here you are provided with current assets. From current assets you are supposed to deduct prepaid expenses and inventories, because these two doesn't make the part of liquid asset. Now once you will deduct from current asset your inventories and prepaid expenses, you will get the value of quick asset, that is 50,000. Now your current liability is already provided, and you know that if current liability is provided, you can get your liquid asset. So quick asset divided by current liability, that is 50,000 by 50,000, you are going to get 1:1 ratio, that is your liquidity ratio. I hope this video might have helped you, and if you have really understood something extra, please don't forget to subscribe my channel, and for next other ratios, please watch my next videos. Thanks for watching.